the biggest thing is watch that trend line. Is the trend line, whether you're following the peaks or the valleys, are they consistently going up?
The good news is the both of us agree there's no bubble in the Twin Cities, so we're not going to see some big housing crash.
There's a lot of opportunity out there and a lot of deals. It's just changing.
We were in negotiations, investing in real estate. They're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amolsch. Hey, I hope you get a lot of value out of this episode. This is the Market Pulse in the Twin Cities. If you get some value, share it with a friend and give us a 5-star review. That will help us help more real estate investors just like you. So I am so excited for another quarterly market update with our good friend, Mike Jacka with Minria out in the Twin Cities. Mike, how's it going, man?
It's going fantastic.
Good. We just got right before we hit record, we said, well, what should we talk about today? Let's update the listeners and the viewers on what the economy is doing and how we could help our real estate investor friends. And of course, Trump came up in the conversation right before we hit record here. So we should probably start there. What do you think?
I don't know. The Super Bowl was last night.
Oh yeah. You want to talk about that?
Not the Super Bowl so much, but on the lines of Trump, I was shocked to see the standing ovation he got from the fans in the stadium. That's the one big thing that we were talking about this morning is the Main Street people are happy about what's going on, and you could see it last night at the Super Bowl. So yeah, there's some people that are not happy that Trump won, but Main Street is happy. Our clients are happy. Our buyers and sellers are happy. I know a lot of our investors are happy. The question now is, well, what we hope is going to happen, will that come to fruition over the next couple of years? Or is it just la la land and we all just got excited and hyped up over nothing? That's to be seen yet.
I mean, you correct me if I'm wrong, but if we're talking about the real estate investor and the impact on the election, the impact the election has on them, probably the two biggest things is going to be the tariffs, which is sort of the hot topic for everybody. And then some of the tax stuff that he's been talking about. I think those are the two big issues. He's got a lot he's doing, right? But a lot of it is pretty minor and it's not really impacting much. In fact, quite frankly, Mike, the tariffs aren't really impacting much yet either. Seems like a lot of threats and a lot of negotiation, but not a lot of action other than the China one.
Yeah, that's what I was going to say. I would agree with you on the tax part, but not so much the tariffs.
Okay.
Because the only tariffs that's actually gone into effect is the one on China.
Right. And it's pretty minor, 10%.
10% on top of what they already had. Because I think they were already at 15. And some people were complaining, and I heard some podcasts this weekend from somebody up in Canada complaining. It's like, well, how come he threw 25% on Canada and a 25% on Mexico, but only 10% on China? It's like, no, he threw 25% on all three of you. They already had 15 on China.
Yeah.
So they bumped it up another 10%, and not on everything, just on certain things. Right. But what we all expected was China and Mexico capitulated, and there is no tariff on them. And the tariffs wasn't on everything, from my understanding. It was but pretty much on like lumber and energy and stuff like that. I don't think it was on all goods and services coming out of both Mexico or Canada.
Right. And so I heard a podcast. It's interesting how you interpreted the podcast you listened to. And then I heard one slightly different interpretation. It was, well, we're just going to do the 10% when he was threatening Mike 100%. You remember that when he was running his campaign was saying, no, we're going to hit China with 100% tariff. And then it went down to 60. And then I don't remember. There were so many different things he was saying.
Right.
But he ended up at 10. So what I heard was, well, maybe it was only 10 because he was actually going to follow through, which he did. And then the 25% was more of a, hey, let's set a high anchor. We learned this in negotiation. You want to set an anchor. So he set his anchor high with Canada and Mexico because he wanted some support on the borders, right? And then that brought them to the table to negotiate.
Right.
And he was never intending to follow through that. Now, I don't know if that's true or not. Obviously, nobody does, but that's what I heard.
Well, I got a feeling he was intending to follow through because, I mean, it was in full effect, and it was only because and Mexico and Canada came back to the negotiating table at the last second. I didn't hear any indications from anybody, not even, from the Trump administration, let alone the mainstream media who absolutely hates him. I didn't hear anybody saying that, oh, he's gonna, overturn this at the last second and not really put it into effect. No, he put it into effect.
Yeah, well, I mean, it is technically in effect. There's just a 30-day moratorium.
Right.
Right. So I think, who knows, but I think maybe what he wants is their support. And if he just says, okay, we're not going to do it, then they'll take their 10,000 troops and off the border or whatever. If it's a moratorium and it's still in effect and it will go back into effect, maybe that is incenting them to follow through with what they agreed to do.
Now, one thing that's coming from the tariffs, and I don't know, we only heard about Canada, Mexico, and China. At least those are the ones I've heard about. But I think there's been other tariffs on other countries, maybe not significant ones, maybe smaller ones. But I heard this weekend that, was it Nissan? I think it was Nissan has committed to building a plant here. And then I think it was, and I can't remember who the other
Volkswagen,
one,
right?
I think it might have been another Japanese one, have committed to expanding their auto plants here. And they started doing that when Trump was the president the first time. And then Biden came in, nothing happened, and they all stopped those plans. And now it's back on the table again. And part of it might have to do with the tariffs.
And now he's threatening EU. So the whole European Union. So I who knows, but let's talk about let's say for a minute that these actually do go into effect. Some of the things that he's talking about, the EU one, for example, Germany is going to be hurt by that the most. But let's say there's all of these imports we're getting from these different European countries, and they start getting tariffs, which is a tax to another country to import goods. What does that do to the real estate investor? How does that impact you and me?
I don't know that it really impacts us from directly, but it might impact the consumer on the back end when they go to buy the houses or to rent the houses from us from their affordability standpoint. How much so, I don't know, but it could have a factor. But it's not just that. I'm not worried about tariffs. I'm worried about our taxes and our insurance and our own utility bills. I mean, those things have been skyrocketing. We were just going through our utilities right now on our personal residence. During the summer months, we got a bigger house, but during the summer months, our utilities this last year, they were running gas and electric was maybe running $250 a month. But the cost of gas and electric have skyrocketed. We're at almost $900 for last month because we just got the bill. Almost $900.
Gosh, Mike.
For gas and electric. That's ridiculous. Now, the year before, I think our highest one for the winter was maybe 700. Now, are we doing a little bit more? Yeah, maybe we've been doing some construction. That's one thing I brought up to the girlfriend is we've been doing construction. So there's been a lot of extra power being used for the so that might be drawing a little bit more electric, but not $200 more. So gas and electric has just gone up. And I don't know that we're using that much more that we have been, but
it's not colder now than it has been.
Well, it is. This winter has actually been a little bit colder. I'd have to go back and look at all that stuff, but I mean, we were just shocked at that. But then you look at taxes. I mean, $6,500 a year for taxes on the property. Insurance is almost $2,800 a year. And that that's only going to go up now because we got to pay now for Florida's hurricanes this summer. We got to for LA fires that just happened. That's gonna hit all of us around the whole entire country for our insurance because they have to offset what they're losing in those other places. So, and we were just talking with one of our members is a note buyer, so he's really heavy into the mortgage and that note industry. So he's into everything, all the data. And the thing that was really surprising to me was over a third of all mortgages right now. So all the mortgages that are out there right now, over a third of your payment is taxes and insurance.
Yeah, that's
And
crazy.
almost 10% of mortgages out there right now, and he's getting this from the Mortgage Bankers Association, almost 10% of the loans out there right now, the monthly payment, over 50% of it is taxes and insurance and private mortgage insurance. So less than 50% of your payment is actually going to pay down the mortgage and the interest on the mortgage. It's 10% of the houses out there, it's taxes and insurance. And for the average loan right now, it's about a third. So I think that's where the biggest issues come into play, is the affordability of everything else other than the real estate, just to own the real estate.
Yeah, I know I don't want to be doom and gloom here, but let's just be honest with ourselves. You're right on all of that, and prices continue to go up. So the home values continue to go up. I think you'll probably show us that here in a minute, in the Twin Cities specifically, but across the nation they're going up, and interest rates are not coming down. You know, there's talk about 1, 2, maybe 3 rate cuts through the year. I don't know if I agree with that, but even if you get 1 or 2, that doesn't mean mortgage rates are going to go down. I mean, I don't
No.
see a way for those to go down, quite honestly.
Either do I. In fact, you know what? I'm just going to bring up a slide. This is not on the regular stuff. This is from a presentation I just did last week for our main meeting, and I do this on an annual basis. Let me pull this slide up, and then let's do a
Okay,
screen.
while you're doing that, let me just
Sure.
close this loop on this tariff thing. I do think that tariffs will cause inflation, and that's going to be more short term. I think long term, they're actually very positive. Okay, and we can talk about that if you'd like. But in the short term, we should see some inflation, and the way you fight back inflation is higher interest rates. So that's one of the reasons, and I think interest rates will stay high. And one of the ways I believe these tariffs will impact real estate investors. So just throw that out there.
Yeah, and I'd love to hear your thoughts on why you think tariffs will be good in the long run. I have
Sure.
some thoughts on that too, but I've never really thought it all the way through. I'm very narrow-minded on just the real estate because that's my life, my everything about that. But I'd love to hear your thoughts on that. But we were talking about with the affordability. So I started this about 10 years ago, but I backdated for a few years. And so every year I update this chart myself. So this is my chart that I have created. And every single year at the end of the year, I go and find, okay, what was the average median price for the year for the Twin Cities market? And what was the average interest rate for the year? And I just print that out and say, okay, well, where did we start out at and where are we at right now? If you look at back at 2010, now granted, that was after the great financial crisis of 08, right? But we didn't hit a bottom until 2011 or 2012. But if you look at the very bottom there at 2010, the average price for real estate in the Twin Cities was coming at 168, and the average interest rate for the year came in at 4.86. That put the average monthly payment, principal and interest, at $887.61. Now, what I should do is one of these days I should go back and correlate to, well, what was I don't know that I could really do that. I was thinking about property taxes, insurance, because like I remember on actually one of the properties I still I think my taxes at the time in 2010, 11, 12, right in there, was right around maybe $1,100-$1,200 a year, and it's right now at $4,000 a year.
Yeah, that's crazy.
So on a property, in fact, one of them, because I still have I took it over subject to. It was one of my rental properties. Took over subject to. My monthly payment on it is $900, and so I guess I fall into that 50% category. So my the payment on it is $968 or something like that. But my PITI right now, I'm paying $1,900 a month.
What does it rent for?
Because my PITI is still around 900. But back then when I bought it, the PITI in that thing was probably around 1,200.
Yeah, that's
now at 1,900, and it's over what 12, 13 years. My payment has gone from about $1,200 to $1,900, but my P&I has stayed the same.
So this is one of the things I'm going to be talking about at the Success Summit when I come out there in March 8th. It's very difficult, Mike, to get cash flow owning rental properties. Now, I still think rental properties is a fantastic investment and it will make you wealthy. We're just not seeing the cash flow. There's other ways to invest in real estate and get cash flow outside of just rental properties.
Right. And you can still get cash flow, just we're not getting the cash flow that we used to get.
Right.
I mean, I was getting, when we were buying properties for a while, just buying the house right out of the gate, we were getting $500-600 a month just for buying them. Now we're struggling to try to figure out how to get $200 a month. So that's where you have to get creative. And yeah, I have changed a lot. I'm not buying and holding rentals anymore. There's still, because I don't need to, I got enough rentals right now to offset my ordinary income. And for me, that's the biggest thing with rental properties is to offset the tax liability on everything else.
I love
We're
it.
not holding the rental properties for the cash flow per se. We're holding it to minimize our taxes and maximize our returns on everything else that we're doing. That's, I think, is the biggest benefit while you're holding the rental property, and then you get the principal pay down and hopefully some appreciation. And then eventually, if you do sell it, you can then either 1031 and roll it into something that's going to have a higher cash flow, which is ultimately our goal.
Right.
Or, I mean, if you are 1031, or if you're holding on to them and taking the depreciation for taxes, basically those properties I'm planning on just holding on to forever. Everything else right now, I've been putting in my IRA, so I don't have to worry about that stuff.
No,
So
I think that's a very good strategy. And one of the things I'm seeing people do is group together. Like they might get 3 or 4 or 5 investors together, and instead of each buying one single family rental, the collective buys one commercial building or a larger, maybe apartment, 20-unit apartment or something where there's a little bit more cash flow. So that's sort of the trend we're starting to see now.
Yeah, but is that an effect of the lower cash flow on the residential properties, or is that a factor of it's hard to find 5 properties for 5 people? It's easier to find one commercial building that 5 people can invest in.
Yeah, good question. It's probably both. I mean, if you think about 5 people and each have $100,000, and that might be a down payment on a nice little rental property, but if you combine those, that's $500,000. I mean, you could just buy more. So I think it's maybe the market's making it difficult to find enough for all of them, but it's just easier when here's the reason I say this. The more expensive the property is to buy, the less competition you have to buy it, because there's other people that aren't going to be able to pull that off, right?
Right.
So if you shrink the buyer pool, you bring down the value of the property. That doesn't mean the cash flow comes down. It's the sales price that comes down. So your ratio, your rent to price improves as the dollar amount goes up. And that's obviously a very high level look at it. And that's not going to work if you're buying a single family home for $4 or $5 million, right? But if you're buying a cash flowing property for 4 or 5, I think you'll find the cash flows better.
Well, yeah, when start talking $1 million properties, then yeah, you're not gonna be able to cash flow those in single family.
Right, exactly. Yeah, that's why I said the caveat. In general, that's why in general, if you're buying for cash flow, the higher the price point, usually the better the cash flow.
Yeah, I mean, I from a macro side, I can see that.
Yeah. I mean, obviously there's exceptions to everything, but let's come back to your chart here. So for the listener that's not seeing it, what he's got here is from year 2010 to year 2024. He's got the median price in the Twin Cities, the interest rate, and the monthly PI payment. And then he added a column here for the price change. And what jumps out here to me, Mike, when I'm looking at this is that dang interest rate. So I know that we're at sort of like close to average rates if you look over a long term, but that's including the 80s when you're at 16, 17, 18%, right? And so that pulls the average up. If you're looking at just the last 15 years, which is what I'm looking at right here, I mean, we're at a historically high interest rate.
Over the last 15 years, sure. However, over the last 15 years, we've been at a rate so low that the only logical conclusion is inflation. Because the cost of money is and I'm not an economist, so don't take this, but this is just for me from 30 plus years of experience in real estate. And following the economy and making and losing millions of dollars, where I have found where things were the best for myself and for the economy was when interest rates on mortgage rates and let's just say mortgage rates were in that 5% or higher range. I think when you get below 5 or 4, even 4%, the economy in whole is paying for that. They're offsetting it. So inflation is going to offset that because that's too low
Mhm.
from a financial standpoint. Because if we're getting low rates that low and the Fed lowers the rates beyond, under that, like the 5%, 4% range, and like I said, I don't know the exact number, just what I've seen. That's going to cause inflation in the future because people have to pay for that. Right now, those are companies that are just getting bailed out to stay afloat. And when the payday comes, somebody's got to pay for that sometime. But if we can keep the rates at the 4 or 5% or higher, then we're not going to be seeing those higher inflation issues. Which again,
I think
correlates with
in
the Fed.
general, you're right. Yeah, in general, you're right. Unless the government can't stop spending money, right? So there's, stimulating the economy artificially with rates or quantitative easing, for example. That's when the government just pours money into the debt market. If you artificially inflate the economy because of those, that will cause inflation. But you could keep spending money, or like Trump wants to do, and we could talk about that too, but cut taxes without a real plan to cut expenses. That also will cause inflation.
But he is cutting expenses, a crap ton of expenses. That's the whole concept of Doge.
Yeah.
I mean,
But we're still running a deficit though.
Oh yeah, we're still running. Well, yeah, we're still running a deficit, but that's what he's trying to get under control. And I think, I mean, with Elon and the Doge kids that are doing all the work, trying to find all this fraudulent spending, I think even if they're not able to do a lot, I think what they're really doing is bringing to the public's view how much fraudulent spending or unnecessary spending is truly going on. I think the only thing that can come out of this is good over the long run. Is that we're now seeing it, and I think carrying on forward, if this momentum can keep running, moving forward, we're going to keep an agency within the government to oversight the spending and everything else. I'm hoping that is a trend that carries on for a long time, which gets back to our opening statement when we were just talking about a little while ago, why at the Super Bowl last night, Trump got a standing ovation because people are happy about what they're seeing and what they're hearing coming out of the Trump's administration and out of the Doge, Department of Government Efficiency, finding all this fraudulent spending. I mean, I heard today on one of the reports this morning that they had found, and I don't remember what the number was, but it was in the millions of dollars on a monthly basis were being spent on subscriptions for probably at one point or another legitimate subscriptions that somebody in government subscribed to for a legitimate reason or a legitimate purpose. But then once they were done with using that subscription and nobody's using it, nobody's touched them, but they're still, because they're on automatic government payments, they're just getting paid out every single month for these little $5, $10, $20, $50, or $100 a month subscription payments that nobody's utilizing.
That's so interesting. And that is something that I think, because the government's so big, would be hard to identify.
Well, that's what
but
they're
clearly
doing.
they are doing it.
Yeah. And right now they're saying, as of right now, it's like in the millions of dollars per month of subscription fees that they have identified so far. But back to the chart, because for the people who can't see it, the interesting thing was the low point. So it started tracking in 2010. It was 168,000 was the median price in the Twin Cities, and the interest rate was 4.86. But the monthly payment was $887.61. It got to a low point in 2011. The median price dropped to 150. The interest rate dropped to 4.65. The monthly payment was $776.12. But you fast forward now 13 years, and we're looking at the numbers ending up for 2024. The median price came in at $380,000. The interest rate rose to 6.9. The monthly payment went from $779.36 up to currently $2,502.68. That's an increase of $1,700 a month for the exact same property.
Right.
That's
and what you're not showing here, but you've done a great job of explaining That doesn't even include the taxes and insurance and how much that has increased.
Correct. Yeah, you take that $2,500, it, just to get a rough number of what taxes and insurance are going to cost you here in the Twin Cities, you could probably figure another $700 to $800 a month on top of that. So you're over $3,200 a month is your average monthly payment on a property. And that's not even including private mortgage insurance. That would be with you having 20% down. If you're under 20, now you got to pay your PMI. So add another $100, $150, $200 a month on top of that. So you're at $3,400, $3,500, and most people who are getting those properties are having to pay the private mortgage insurance.
Yeah.
So you're looking at $3,500 for the median price property in the Twin Cities.
Okay, so if I was going to try to extract a point that you're making with this chart, is it just affordability is out of whack? Like there's a bubble here we got to watch out for? Like how can I use this chart to benefit?
Well, this chart, actually, I have another chart. This next one here, let me see if it's right. Jump to the next chart here. This one here, this is the one I put together just the other night for our market update. Median price coming in at 370. Interest rate last week was at 7%. That puts the monthly payment at 2461.62. Right, and then this chart here shows, oh, what happens to the monthly payment if the interest rate goes up. All right, so then the monthly payment is going to show a breakdown of going from 2461. If we just go up one whole point, it's going to go from 2461 up to 2714. So what I have been paying attention to and noticing, and for those of us who follow the market data, is buyers buy based on the monthly payment. We all know that.
Right.
And so I've been seeing a bouncing of a price range. So it doesn't matter what the interest rate is and what the month and the median price was. What it matters is what the monthly payments coming in. And so over the last several years, when we monitor this on a monthly basis, every time I see the monthly payment for the principal and interest in the Twin Cities get about $2,550, $2,600 or above, the markets get really soft and really slow and stay that way until either the price comes down or the interest rate comes down to bring that monthly payment back under $2,500, $2,550. So in that 24 to 25 is what I feel is that sweet spot for a monthly principal and interest in the Twin Cities. That's what I get out of this.
Okay. And I think that's pretty universal. I've even heard the interest rate higher than what you're saying. So closer to 6%. And that's sort of the tipping point. But yeah, I understand.
But I'm talking about monthly payment. Yeah, I understand the interest rate, but that's based on the median price staying the same. What I'm saying is it doesn't matter what the interest rate or the principal or the price of the property or the interest rate. What matters is between those two, where's the monthly payment coming in? That's the magic number.
And that's a snapshot, obviously, because we have wage inflation that's far higher than regular inflation, at least currently. So people's incomes are raising faster than supposedly the value of the house.
We hope so, but that's not.
Yeah, we don't know that. I mean, that's why I don't want to go down this rabbit hole. But for the listener, this is not adjusted for either inflation or wage inflation. And presumably we're making more money than we were in 2010.
Right, because if you go back to that other chart, like I'm saying right now, that happy median is probably between 24 and we'll call on the high side 2,600 for the monthly payment. But if we go back to our other chart, that number was obviously a lot lower 10 years ago, 15 years ago. So I'm just saying right now, inflation adjusted, I do think the monthly payment is around that 24 to 2,600 range. And as long as we're staying in that range, for now, I feel confident that we're not in a bubble or anything like that. If I start seeing that monthly payment get above 2,700, then definitely we're in a bubble. And the only way it's going to get lower than I think in that 2,400 range is if the bubble busts. That's how I'm looking at it. And if we were looking back 10 years ago, we go back to 2014, well, the payment was around $1,000. Okay, well, that tells me that we were probably in that $1,000 to $1,200 range was that comfortable range at that point. And if it was, if the payments got up to $1,400, we were going to see a bust in the market. So I do think this is inflation adjusted.
Okay, gotcha. Yeah, and I tend to agree with everything you said. Other than the bubble bursting, because the only reason I'm challenging that one piece is because the way the Fed has reacted to all the inflation from the COVID stimulus has been rather remarkable. Despite what people think about the Fed, and I have my own gripes for sure, but I think how this has been handled to this point has been pretty great. And I mean, it almost feels like they actually achieved their goal of a soft landing. Now, there's still time to see what actually happens here. But let me elaborate a little bit here, Mike. They have raised interest rates at a staggering pace, right? It's never been raised that fast from a starting point to where it ended up in the history ever. It's
Right.
never gone up that fast. And a lot of people were pretty concerned with that. But if you look at where we are right now we have a pretty high federal funds rate, high mortgage rates in comparison to the last 15 or 20 years. So that gives and they've been stripping money off the balance sheet, by the way. So they've been paying off some debt as far as bonds and mortgage long-term debt they've been paying off. So they were shrinking the balance sheet and they've increased rates. So what that does is it gives them flexibility. If the market does show signs of softening, they have room to raise or lower that interest rate and stimulate the economy. What was scary is when we were at 0% federal funds rate, 0.25, 0.5% federal funds rate, because there's no room to adjust. So if the market does go into a recession, they can't recover from that.
Yeah, no, I guess I agree with that 100%. I can't disagree with that. So
And
I mean,
I just bring that. So I mean, when you hear bubble pop, and that definition can mean different things to different people. But when I hear that, it's like we're looking at a 30% drop in value. That's a bubble bursting in my view. I just don't think that you will see that even if the mortgage payment goes high, because there's room to lower the interest rates.
no, you're right. And even if that's another thing too, and is even if the bubble busts in real estate, it still takes a very long time for that to change, for that effect to change. Because if you look back the last time the bubble busted, I mean, it actually, the bubble popped in 06. It took 2 years for it to bust because they were still inflating the bubble, even though the bubble had already busted.
That's right.
So prices were starting to come down in 06, and they're coming down at a pretty steady, consistent rate, but not dramatic. And then 08, end of 08 hits, and then then it went quick, but it didn't go quick like the stock market does or like Bitcoin does. It went down faster than it ever did in history, but it still took 4 years to reach the bottom.
That'd be interesting. Maybe one day you and I do an episode just on that, because what you're saying is absolutely right, and it's not very well understood.
Correct.
They hear Lehman Brothers go down, which is that's when the public thinks it started, right? But you're right, that is not true. This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. What you were just saying about the bubble starting to pop, or maybe there's just a pinhole at that time in 2006, that is right. And that's when interest rates started going up and everyone was in the adjustable rate loans, if you remember. So in 2006, when you started seeing those interest rates go up, that's sort of what put the market into the tailspin. So if you have that chart, you will see the interest rates being significantly higher in, 5, 6, 7, even beginning of 8, compared to what you showed there in 2010.
So one of the charts that I had was coming from the Fed, and it was going back a little bit further. It was going back to like the 80s, But if you take, this is the median price graphed out here on the bottom of the chart. So for those who can see
So
it.
this is the more of a national view.
No, this one here is
Oh, it
still
just says right here, Twin
local,
Cities. Okay,
but
gotcha.
it's almost exactly the same as the one I pulled up from the Fed. Only the Fed went back another 20 years. And that was on a national basis. So, but our Minneapolis Twin Cities chart follows, the graph. Maybe the numbers may not be exact, but the curvature of the graph and the trajectory of the graph is exactly the same. But if you pulled this back to like the 1980s, and then you start down here and you put a straight line, it's gonna pretty much be consistent where it's hitting the tips of most of these after 2010, but the 2006 timeframe was that bubble, that bust that popped. We're not in a bubble right now. I don't see it. That's the other thing, because we don't have that overinflation that we had in this period, in the early 2000s through 2006, where it peaked out and then it started coming down in 08. But if you go back to like the 80s and we put a line here, like all these peaks here, and I know it's gonna be hard for anybody who's listening to the radio, but you got or just listening on audio, not watching the screen. But we have every year you have seasonally adjusted. You have the summer months and then you have the winter months. So the summer months are always going to be the peaks, and the winter months are always going to be the valleys, right? But if we take it for a chart, and I did this, I took a straight line out of one of the graphs and put it from like 1980 to current, and it was pretty much like the early 2000s. That big bubble was way above the line, like significantly above the line. But then you hit about 2012, and that line was kind of staying right at the peaks of where the peaks have been every single year, right up through 2022, 2020, maybe 2022, right when COVID hit and they started printing the money like crazy again. And then that's where the peaks started getting above there, but we don't have, but the valleys are coming back down in that line. So our lows are hitting the lines that we would be on like a 40-year trajectory for real estate values, because appreciation has been coming in pretty consistent for us here in the Twin Cities, and I think nationally right around 4 to 4.25%. I think is where the numbers have been coming in. Because yeah, we do have the peaks, but those valleys also bring them back down in the winter months. But that early 2000s, yeah, it was dramatically above the lines here, and the ups and downs were way up here, but now the ups and downs are right here. So I think we're still in line, but we are starting to see, like especially in 22, 23, it pumping back up there. But here in 2024, it looks like we didn't get as much of a increase in value. That is because of the interest rates.
Right. Yeah, this is good. I really like this graph and how you're describing this to me. I mean, I've seen this before. In fact, I think you've shown me this before on this podcast. But what I haven't thought of until you just pointed it out is up until what year is this? 2000 for the 2007, it looks like is where that's where it really starts to tank. So prior to 2007, what I'm looking at and what Mike is describing as a bubble, there's not a lot of volatility. It's sort of straight. You can't see what's the summer, what's the winter. After 2007 and definitely after 2008, it's a very defined line. Like it's summer, winter, summer, winter, summer, winter. I could definitely see the seasons.
And I can explain why the seasons disappeared during that time frame.
Okay, because I think that's part of the point here. Why you're making the argument we're not in a bubble, but tell me if I'm wrong. Yeah, explain to me, why are we not seeing the seasons?
So in the early 2000s, the reason we didn't see the seasons, and I racked my brain on this one. In fact, this is the whole reason I started MinRia in 2002. I didn't start it because of this, but what happened was I've been in real estate for over 10 years already at that point. So, well, not about 10 years. So I was about 10 years because I bought my first official rental property on purpose in 1992, 1991, 1992. Bought my first property as an investment to live in 1989, and then I house hacked that one, and then that's what got me interested in real estate. So I purposely bought my first one in like late 91, 92. So I've been in this for a long time at that point. And then early 2000s, I could not figure out what the heck was going on. because prices kept going up, just skyrocketing. And I remember people buying new construction homes at the time because we had a shortage of housing in our area. Builders came in and started overbuilding, or well, they end up overbuilding eventually, but they weren't overbuilding at that time. But I know that you buy a house, it's like buying a car. It goes down in value immediately. It's supposed to, anyways. And it had for the previous 100,000 years. It's never gone up in value from the time you bought it to the next day. But here, all of a sudden, people were getting properties under contract for new construction, having broken ground. By the time the house was built, they were selling the houses and making a profit and at closing by the time they were built, because they just kept going up in value and up in value and up in value. And I was trying to figure, okay, and then that was affecting the existing homes, which I was buying and flipping houses. Like, so I finally figured out there was a correlation between those two. I'm like, what the heck is going on? And then it just got everyone I'm talking to, like, well, I went to closing and I closed and I put 20 grand in my pocket. I went to close and I walked away with a check for $8,000. I'm like, what do you mean you walked away with a check for $8,000? You're supposed to come to closing with a check for double that, and you're telling me you didn't have to bring that check, but you got a check. And then I started selling properties to buyers, and they started getting these checks. I'm like, what in the world is going on? Because it got so easy to finance. Because it got so easy to finance, people were just buying houses whenever, and then they just kept on refinancing them. And it's because they were refinancing them, they weren't selling them, kind of like they're not selling them now. That just kept the prices pushing up, and the people who were in their houses just kept refinancing. So once every year and a half, they would refinance. That just kept driving the values of the real estate up and up and up. So that's why I don't think we saw the seasonality there, because even in the winter months, because of all the refinances that were going on, that was pushing up the values of the real estate. And
So
the
the
lack of inventory.
seeing the seasonality is actually, I mean, it sort of looks volatile to me when you just look at it, but in reality, that volatility that defines or shows you the seasons is actually a healthy.
Yeah.
Like, you want to see that.
Yes, you do, because we know that the most of the transactions that happen are going to be in the summer months, and that's going to be your move up buyers, because they're waiting till the kids got out of school, or maybe they graduated from college or whatever, and now they're empty nesters, and they're going to upsize or downsize, and that's usually going to happen during the summer months. They're not going to do it while the kids are living at home. So that's why, as a real estate agent, or as an agent in the real estate industry, realtors, we experience more activity in the summer months. And that's why, like here in the Twin Cities, we have the Parade of Homes that starts in March, right? Because to get excitement from everyone, because it's been slow during the winter months, get excitement in there so that people can start planning and maybe find a property, get it under contract in March and April so that they can close on it in June and July when the kids are out of school. Right? That's why we see those seasonally adjusted. And then of course the winter months, you get the holiday seasons and people slow down, and they really don't want to move unless they absolutely have to in the winter months.
Yeah, this is great. I legitimately just learned something here, and I think I'm gonna study some other graphs and see what I see, if is this unique to the Twin Cities? Is somewhere like Denver, where it's not as, I mean, we still have the seasons, but we don't have the impact of the seasons like you guys do. Our winters aren't as harsh, so that's part of it.
I don't think
But
it's that unique to here. I think this is pretty much consistent around the whole country. Because as I go and speak at other RIAs, a lot of times I go and pull up their data. Because like this data here, this is free public data.
mhm.
And I found it right on the Minneapolis Association of Realtors. So I just go on whenever I'm going to go and speak at a different market. I usually, as long as I have the time, I'm going to go to their board, find their board of realtors, and on the board of realtors, they usually publish something very similar to this. In fact, the company that provides this is called InfoSpark. And so they're just like a third party data aggregator that just pulls data from the MLSs, and then they feed it back in a readable, consumable, digestible format that the general public can look at. So it's not high level detail. It's just the broader macro view of your market. And they provide it to almost every single board that I've looked. Well, I shouldn't say everyone. I've seen a couple of them that were smaller communities and smaller markets that didn't have a large enough maybe MLS system to be able to afford that type of a additional service. but all the majors, I've seen this, and when I look at it, it's generally pretty similar to this type of a graph. I mean, the numbers are obviously different because of different median prices from market to market, but
So
the
would you
trend
say,
is the same.
then, Mike, if we saw that this graph sort of level out and those seasons come closer together or almost disappear, that would be a warning sign of something?
Well, I can only correlate it back to the early 2000s, but I guess, yeah.
Yeah, maybe so.
As long as we're seeing the seasonally adjusted changes and they are going up and down, and the biggest thing is watch that trend line. Is the trend line, whether you're following the peaks or the valleys, are they consistently going up? But if they start to flatten out, and yeah, maybe that is a good point. Never thought about that either, Kevin.
I've
If
never thought
those
of
two
it.
start getting closer and closer like they did in the early 2000s, that might be a sign of a bubble coming.
Yeah, that's interesting. Cool. Well, now I got something to think about. I'm gonna,
Yeah,
this
now
is
you gave me
awesome.
something to think about too. I never thought about that part of it, which is one of the reasons why I love doing this stuff and start talking to other people and brainstorming, because that's really what we're doing is brainstorming
Right,
here.
exactly.
Just other people get to listen into our brainstorming sessions.
The good news is the both of us agree there's no bubble in the Twin Cities, so we're not going to see some big housing crash. Now, we probably are going to see it stabilize, which you're seeing on your graph here, flattening out a little bit. That does not mean it's a crash. It does not mean it's a bubble. It's not a bad thing at all. In fact, it's probably necessary to have a little bit of slowdown in the appreciation. So nothing that you're saying, nothing I'm seeing in this graph concerns me at all.
Well, and we have to see it flatten out, and that's why they raised the rates in order to get prices to flatten out, because they were going up too fast, too quick. So we had been in a good trend line, but you can see starting in probably around 2020, those peaks jumped significantly. But I think we're starting to get back in line with, and that's what the
Yeah.
Fed was they were trying to accomplish by raising the rates.
Yeah, that's exactly right. And it's working. Again, kudos to them because man, I thought we were going into some kind of, I didn't think the housing market was going to go into a recession. There's different types of recessions, by the way. I didn't think housing was going to go into a recession, but when I saw those interest rates going up like they did, I thought sure unemployment was going to hit 5%. I thought like, I don't know what's going to happen. I always felt housing was pretty strong because of the supply and demand, that just the basic fundamentals has been strong. Because you don't really know what's going to happen, do you? And now we could see that the market is surprisingly resilient, especially in housing.
Most resilient market in all time.
Mhm.
Always has been, probably always will be.
Yeah, and some people, I don't know if you have this graph, but some people will say, especially for you realtors out there listening, or lenders, frankly, looking for purchase business, we might be in a recession right now, not because our home values are going down, but transaction volume is way down.
Well, I would say we are in recession, but not for, like you said, not for the real estate, but for a lot of the general economy. We're in a I would say a major recession, and you want to know how you can tell we're in a recession? And I just started
Well,
noticing.
I used to think, I mean, I was taught, Mike, that it was GDP and negative growth.
Well,
But that's
that's the
proven.
technical. That's the technical side
proven
of
to
it.
be wrong, by the way. Although, I didn't even know that you could go back years later and adjust GDP. I didn't know that was even a thing. So where
Well,
we did have multiple
anything in the
quarters,
government's possible.
yeah, that's true. I mean, you hear about the jobs numbers being revised every single month, right? They're never even close to accurate on those. But the GDP, I just haven't seen that. And we did see 2 negative quarters, which is an indication. So is the inverted yield curve, by the way. We've seen both of those, but we haven't had an official recession yet. So it's interesting. How do you define it?
Well, this is something that I started noticing probably about 2 years ago, and I've been kind of paying attention to it. And I don't go out to eat a lot, okay? But when I do go out to eat a lot, I am finding that everywhere I go, there's a wait. And the reason there's a wait, because the 13 other options that I thought about going to are no longer in business.
Oh, okay.
They're closing down. Like we were just talking, it was my mother's birthday. So we were talking about different places to go have dinner, and try to pick a different place that we haven't been to in a little while. And we, as a group, we thought of about 7 or 8 different restaurants that we would all like, yeah, let's go to. And it's like, no, that one's closed. No, that one's closed. That one's closed. Or they're closing so early that you can tell that they're going out of business. So there's a couple local like cafes here that they used to be open for dinner, and they're not even open for dinner anymore. Now they're just open, through lunch. Right. And then a couple of them that were dinner joints that they're closed, they used to be open until midnight. They're open until like 8 o'clock at night because people aren't going there anymore. Right. But that's in the blue
Interesting.
collar neighborhoods.
Yeah.
I go out to like West Minneapolis, which is more of a white collar, and we're not seeing a slowdown. The restaurants are still there. The entertainment is still there, but you go in the blue collar where it used to be, a lot of restaurants, a lot of family restaurants, a lot of cafes. I'm not seeing them. They're closing down. They're disappearing. People aren't going out as much. And when you are going out, and this is the big thing too, is when you are going out, I'm just floored. I'm just trying to find the right word without swearing. I mean, I'm just shocked at the prices of what we're paying for a meal.
Yeah, me too.
It's beyond belief that, just in a short few years, we could be paying these prices for our meals. And then a couple places that I've noticed the prices haven't gone up, but the quality of the food and the portions of the food have gone down. So we're seeing shrinkflation, which I think is all part of the recession from the economy.
Yeah, and I mean, if I don't disagree. I've experienced some of that here in Denver as well. The statistics don't agree with you though. I mean, unemployment is now, I think it's 4%. I don't know what it is in the Twin Cities. I probably should have looked that up. But why I do agree with you is because what we're not seeing, and it alludes to what I just said with the realtors, we're not seeing the gig workers or the underemployment instead of unemployment. So if you have a realtor that's used to making 200 grand a year because they're doing a couple of deals a month, and then all of a sudden transaction volume falls off a cliff, which is what we've seen with the interest rates, and now they're doing 6 a year instead of 24, their income was slashed, but they're not showing up in any of the reports, right? So they're feeling it.
Right, but how about I don't even know what the percentage is, but all the people that were collecting unemployment and lost their jobs during COVID and are not back to work, if they're not in the unemployment numbers either, they're unemployed, but they're not in the unemployment numbers because
Well,
they've
if
been
they're actively
unemployed
looking,
for
they
so
should
long.
be. They should. Here's the problem with
Why
unemployment.
would okay, we're gonna go down a rabbit hole here, but why would they want to go looking when the government is making it too easy for them to not look?
Okay, yeah, I agree with you. Yeah, we could go down a rabbit hole. What I was going to say is the unemployment is really hard. I mean, it's an important number, and we should know that, especially for following the economics. But it's not reliable. One, we see the adjusted every single month, so even the initial report is, it's not right. And two, it's all based on surveys. So how reliable is that? My thought is that the unemployment, what they should be considering, and maybe they do, and I just don't know that, is the people on unemployment benefit. That should be factored in somehow. But I don't think that's true. I think it's all surveys.
Well, and another thing too is, and this goes back to, I don't remember who said it, but it was somebody had asked one of the billionaires that had filed bankruptcy a couple times in their lives, like a repeat bankruptcy guy who's rebuilt himself back up a couple times. And they always ask him, well, when you went bankrupt, how did it happen? And he said, slowly at first, and then real fast at the end. Well, one thing that I noticed with my businesses and my personal expenses, my income went down this last year. Now I did a lot of volume, and I did more transactions, I think, than this last year in 2024 than I did in the previous couple of years. But overall, I made less money than I did the previous couple of years. And so I had to sit down and think about that, and we had to make some adjustments and do some cost cutting and all that. And it was really hard to do that. It took us a couple months to do some cost cutting and everything else to get our expenses back in line. But and I had to go through that, 15 years ago, And 15 years ago, I didn't have a support group to talk about it and get advice and suggestions and help because I was all on my own at that time. Now I've got the support groups. So I've been out talking to a few other people in that I mastermind with and rely on for support and just get together with and my circle of friends that are doing the same type of things. And they've all said that they've started to notice the same thing. They haven't really dug into their numbers because let's face it, we're small business entrepreneurs. We do not follow our numbers until our numbers are not there anymore. Like we don't start paying attention that our bank account's going down until our bank account's down and we can't make a payment because we're focused on trying to build the business and bring in the revenue. And we usually get to a point where like once every 2 or 3 weeks I go through and do bills, and then that's when I realize, oh crap, I'm running low on funds. Or I get a notification from my bank saying, hey, my operating expense account is low and I got to transfer funds. Right? So I've been noticing that myself, that my income went down even though I was more busy and did more transactions last year. So
Interesting. All right, Michael, it's been a great hour with you as always. We do this once a quarter on the Real Estate Educators Podcast. Is there anything else you should share or you want to talk about as we close out here about your local market there in the Twin Cities?
yeah, I think there's a lot of opportunity out there and a lot of deals. It's just changing. It's not as easy as it used to be to find the deals, but they are out there. We are changing one of the things is we're changing is our marketing. So I'm revamping all of our marketing because a lot of that stuff that I've been doing has gotten stale. And then I've been starting to change it, and I'm starting to get a little bit more responses yet now on my marketing. I'm also I'm getting out there and networking more with realtors and mortgage brokers to get those leads from them. Whereas the last several years, they didn't need to give us their leads because if they had a lead, they were going to close it if it was a viable lead. They're now starting to run into more and more not quite qualified or not qualified enough for them to make a living on it, but there's still something there. So we can help the realtors and the lenders put their deals together by coming in as long as we know the creative side of things. So I'm actually really excited about what's coming. The way I see things it's getting harder and harder, which is good for me because I'm the creative investor. And then if I need financing, I got people like Kevin to go and get loans for if I find the right deals. Just got to get out there and find the deals because they're there. I'm just seeing a lot of people getting frustrated right now and leaving the market or not doing anything because the deals aren't super easy. They're not coming to them, so they're getting discouraged. And I say, don't get discouraged, but you do need to change how you're doing it and get out there and get a little bit more creative on how you're finding your deals. Start networking a little bit more with not just the real estate investors, but other professionals in other industries as well. Not even necessarily real estate industry, like join a local chamber of commerce or a BMI group or something, or hit some meetup groups that do some other social events and just let people know you're in real estate.
What great advice. What a good positive message right as we're closing out here. We're going to do something a little bit different than we've done in the past, Mike, because you know what I forgot to do? I just assumed everybody knows who you are, which probably most listeners do if they're listening to this Market Pulse. Why don't you tell us quickly who you are, what you do, and then I'm going to just plug the Minria.
Oh, well, thanks, Kevin. Yeah, I run the Minnesota Real Estate Investors Association. We meet monthly, the first Tuesday of every month over in Fridley at the Banquet Center of Minnesota. If you've never attended, come on out. Your first event is for free. You can get a free guest pass on the Minria website. And then we provide a lot of tools and a lot of training for investors. And I work with other investors. I buy from other investors. I do some partnering with investors. But we're just a local community of like-minded real estate entrepreneurs who just trying to figure things out and find deals and network with other people who think like we think, and we can have these conversations like Kevin and I just had, because I can't have conversations like this with my family and friends that are not real estate people, because one, they don't get it, and two, they're not interested.
Right. No, that's exactly right. And I'm a big supporter of Minria. I think what you're doing for the community is absolutely huge. It's fantastic. I know the reasons you started it and how you wanted that support and how now you're providing that support to other people. So for the listener, Mike's been in business for years and years. You heard him say that. He's a real estate investor. He's a business owner. Absolute great resource. You could find out more at mnreia.com. It's mnreia.com. And then finally, he's been a big supporter of us as well. And he's a speaker, frequent speaker at our annual event. And also you guys get a booth, you're a vendor, you support us. So I really appreciate that. I don't know if you're speaking at this one yet because I'm sort of hands off of these things these days, but I know you've been a speaker many, many times.
I'm pretty sure I am.
Okay, I think you are as well.
Yeah.
So come out and meet Mike live. Come meet me. I'm flying out there with part of our team from Denver. We're going to come out there and put this event on. We only do it once a year. It's the Minnesota Real Estate Investor Success Summit, all day, very inexpensive, affordable. It's like $40 and you get a full day of speakers and networking, and it's a lot of fun. We're just, like you're talking about, Mike, it's just a community of people trying to help each other. We're not making any money on the event. We really are trying to support the community, and we want to do deals. That's why we're all here, right? We want to do deals together. So mniss.com, and that's on March 8th. And anything else you want to say before we close out here?
No, I'm good.
All right, Mike. Well, thank you again for another quarterly market pulse update on the Twin Cities. You spent your time with us. We really appreciate that. I know you're busy and you got a lot of things you could be doing, and you chose to be here. For the listener, you could listen to lots of different podcasts. There's lots of choices out there, and you chose to tune in here. We so appreciate you. Hopefully you got some value. If you have, 5-star review, and I hope you make this day a great one. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.